Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 437. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Long and illustrious list of podcasts about life insurance. We're at the top.
It is. We are.
Yep.
That's how it works.
Broadcasting from the road today.
We are doing that.
One of us.
Yes, one of us.
One of us are.
So if there's, yes. That's so many different ways to take that.
I know.
And so many things to cringe at the same time. So yeah, that's how it works. And here to talk about real life insurance. But if you'd like to join the Insurance Pro Blog Roadshow, we'll have the tour dates up on the website soon.
That's right.
You don't have to buy any tickets. You can just show up at the hotel for breakfast, and maybe we can.
We'll just set a hat on the floor, and you can throw dollars at it. Or quarters. That's probably more appropriate.
It'd be better if it were a violin case, just so people ask where the violin is.
That's right. Oh, well. Anyway, so we're here to talk about expenses.
Yep, we are.
All right. As they pertain to life insurance. I didn't want to think people to think we were just going to talk about expenses in general, because that sounds like a pretty boring podcast. Would it be more boring than what we normally talk about? I don't know. That's
a challenge, sir.
Yeah.
That's a challenge.
So expenses in life insurance. It seems to be something that people think a lot about, and certainly people on the internet like to talk about it.
Yep.
So
yeah, and you know, we have been on the opinion for a while that expenses are not trivial, but they don't play as substantial a role in the decision to buy or not buy as a number of people might suggest.
Right. The one caveat I have to that is assuming that the policy was designed and set up correctly from day one.
Yep.
Expenses can be much more relevant with a poor design. As it relates to outcomes. But now I'm jumping ahead. So
yep, well, that's okay. So yeah, if you buy the wrong policy,
right, there
are going to be expenses associated with that for different reasons.
Yep.
They accomplish different objectives. And I think that the big problem that a number of people have about our view on this, as we have discussed it over the years, is the fact that there's a few things that we've left out that we're going to discuss today. Not that we were holding back. We just, sometimes when you've been doing this for a long time, there's things that you take for granted and you know what you know, and you don't really think about the fact that other people don't know that.
Right.
And I also think, though, that there is a little bit of a lesson in this discussion, a fable, if you will, that truly, if you want to shift focus and attention in the way that we're advocating for, it's going to change the way you look at other things outside of life insurance. I will suggest for the better.
What things might those be?
Oh, I think it really comes down to parsing the important from the unimportant.
Okay.
I'll be somewhat cliche and a little hokey and say that I view the way people look at expenses of life insurance, which is the way they look at a number of other factors as they make evaluations for purchases or decisions in life, in a way that's kind of like trying to drive by looking through the rearview mirror.
Well, that sounds bad.
Yeah. So, heavy-handed, hokey part of the episode over. We'll now get into the details of expenses and why. I'm not saying they're unimportant. I'm just saying they're not as significant on an individualized analysis standpoint as people like to suggest they are, or some people want to try and dive into.
Well, let's just be straight up. To me, this is what I see people do. They look at expense ratios of an exchange traded fund or a mutual fund. That's usually the context. That's not us saying that. It's a viable comparison. I'm just regurgitating what the internet does.
Mm-hmm.
And they will say, well, this mutual fund has this expense ratio and this one has this much lesser one. So you should buy this one because it's cheaper.
Yep.
And that to me is you are narrowing the discussion. And okay, if they're both S&P 500 index funds, totally viable comparison.
Mm-hmm.
But that's not what I see people do. People will say, I got this fund and this fund. This one's better because this one's cheaper. I'm like,
yeah,
but they both do entirely different things.
Yep.
So you're not comparing apples to apples at all.
No.
And so what people tend to do to bring it back to life insurance is go, well, if I buy that whole life policy, the expense is 50% in the first year because I only have the cash values, half of what I paid in premium.
Yep. So the expense ratio is 50%, right?
No, it's not, but but that's what people see.
Yeah. Yes. So there's often a conflating between something like an expense ratio and something like a load.
Right.
So an expense ratio would be the implied expense to own the investment, if you will, year over year over year.
Right.
It's a deduction from the cash that you have, in essence. Whereas a load would be a deduction from any purchase that you make.
Right.
So when you buy into a mutual fund, if they have a load fee, there's a deduction from the investment.
Right.
And what remains goes to the actual cash
right.
that you have or value that you have in the fund.
The load itself has nothing to do with the ongoing expense of owning the thing, whatever it is.
Correct. All of this is applicable to life insurance. There is a load, in essence, every time you pay a premium.
Yep.
They get
deducted. And it does have an impact. We're not even trying to say it doesn't have an impact. Of course it does.
Correct. That's why in the first year you buy a policy and you don't have 100% of your premium as cash value.
Right.
And we could argue that load is a bit heavy-handed when you look at other things you could be doing.
Right.
But there are things that you get with life insurance that you're not going to get with those other options. Death benefit's a big one.
Yeah.
But certain guarantees about your cash is another one.
Mm-hmm.
Because if we were to illustrate an index fund the way that life insurance must be presented, the guaranteed column would be 0.
Right. That's right.
So life insurance values as they unfold into the future are somewhat known.
Yeah.
With a pretty high level of precision.
Right.
Like if we put a whole life policy in force for the sake of cash accumulation, we have a very good idea where the cash will be 10 years from now.
Right.
We're not going to be exactly correct, most likely.
No.
But we have a much, much more solid and precise understanding of where the cash is going to be 10 years from now than we would ever have in an index fund.
Right.
Or any other style of mutual fund or exchange traded fund or individual investment.
Or a piece of real estate or,
or gold or Bitcoin or any of those things.
Right.
So that precision means we don't have to really get super into the weeds about the expenses. They're already known by virtue of zooming out and looking at what the cash will be in year 10.
Right.
Or 15 or 20. It's totally arbitrary. It doesn't matter.
Right.
Which year we're talking about. But we already know that. We don't know that when it comes to any of those other things we just mentioned.
Right.
And that puts a little bit more significance on understanding the expenses of those things, perhaps, versus life insurance.
Right.
So, to use a fancy word, life insurance is a bit more deterministic with regards to where it's going. And that helps us from the sheer need of diving in waist deep to the expense breakdown of the policy.
Right.
All of that being said, for those who are insatiable in their need to put a number on it. We don't know exactly with whole life insurance because none of the expense breakdown is ever disclosed.
Right.
That's just a characteristic of whole life insurance. But we do know what the expense breakdown of universal life insurance policies are.
Right.
And because they're both life insurance products, there's no reason to believe one would be exceptionally more or less expensive than the other one from the insurance company's eyes.
They have to insure against the eventuality that you're going to die.
Mm-hmm. And
it
whether
doesn't
you
cost more or less.
No.
If it's
whether you own whole life insurance or universal life insurance, the cost of insuring you does not change.
Right.
So, given that, we know
how they account for it is the difference.
Yep. We know that over a lifetime, the typical expense ratio equivalent of indexed universal life insurance, when it is designed for cash accumulation, is somewhere in general around like 0.25, maybe 0.5 on some of the more some other products, the slightly more expensive products that are designed a little bit differently.
Yeah.
But in general, 1/4 to 1/2 of a percentage point is the expense ratio equivalent.
Right.
For indexed universal life insurance. There's no reason to believe that would not be the case, or roughly the neighborhood of whole life insurance.
Yep.
There's slight difference in the way whole life insurance qualifies as life insurance, and so the death benefit needs to be a little bit higher. So, okay, there's an argument for a couple tenths of a percentage point higher in that case, maybe, but they're still going to be relatively similar.
Right.
Now, 1/4 to 1/2% ongoing as an expense ratio for what is effectively a managed fund, if you're putting it in force the way that you and I typically do for people, that's pretty good.
Yeah.
It's not super low cost ETF expense ratio good, the 0.05, 0.1% expense ratio.
Right.
But remember, there are things you get with life insurance that you do not get with those things.
Absolutely. A death benefit.
Mm-hmm. Mm-hmm. But even walking through that entire discussion, ultimately, the question that I always come back to, that people sometimes get, sometimes they don't, is who cares?
Yeah.
Because
that's been my point for a long time.
Because realistically, the evaluation shouldn't be what is the expense ratio. The evaluation should be, all right, if I put $50,000 per year into this thing for the next 20 years, and I retire, and I'm thinking about using it as an income source, what do I get?
Right.
And we can model that. And again, we have a decent amount of precision when we model that. And we look at that, and the determination is either that is satisfactory or it's not.
Yep.
And if it's satisfactory, then you should buy the policy. And if it's not, then you shouldn't.
Right.
We don't have to go any deeper into expense ratios or equivalents or any of that stuff.
Right.
Because it's immaterial.
Mm-hmm.
It's not going to change. It's not up for negotiation.
100%.
So it's
going to be a boring episode if I just agree the whole time, but I mean, I do on this issue.
The problem, though, is a number of people get lost in trying to figure out what the expenses are.
Right.
And I've had a number of conversations with people who bought what were really just not great whole life policies for cash accumulation.
Yeah.
And they'll often ask, well, what's the expense of the policy? And I understand that this is new to them. But I often say something to the effect of, well, we don't know, but it doesn't really matter because we can look at where this thing is going. And it's not going in the direction that you need it to go in.
Right.
So if that's the reality, then the expenses are insignificant. You need to do something else. Cancel the policy, put the money in some other thing, move it to a new policy, move it to some other insurance product, like whatever it is. It's the options are all on the table, but trying to figure out exactly what the insurance company is charging you to have this policy right now is not going to get you where you're trying to go.
Right.
Because even if we knew the answer, that still doesn't.
It's not negotiable. So.
Right.
Right.
And that's one of the key things that I want to bring up today, because we now have the vantage point of talking to a lot of people, hundreds or thousands, who have either bought or who have considered buying. And the interesting thing about doing this over all these years is that we have data from not just the people who bought, but from the people that engaged us who didn't buy.
Right.
They're all data points.
Mm-hmm.
And we get to look at that, and we get to start to make observations, have understandings, and we can even make inferences about behavior patterns and what is typically correlated with various circumstances or outcomes.
Right.
And we can tell you overwhelmingly, the people who act as if they don't care about the expense side of this are the ones who come with the most amount of money. They buy the largest policies, and they tend to just have successful lives.
Right.
And
I would say the general characteristic is people who make a decision and follow through, and they just don't spend a lot of time obsessing about things they can't do anything about.
Mm-hmm.
They look at they focus on the net result.
Yep.
And go, okay, well, we're headed in that direction.
Right.
So, and I like that. I'm good with that result. And so now every year I'm just going to make my premium payment.
Yep.
Not to say that we don't ever talk to them or review things. Of course we do.
But they're not worried about what the insurance company is earning off them. Because they've looked at what this purchase does.
Mm-hmm.
It meets the goal. And now we're done thinking about it.
Right. Exactly.
And that's a very different way of thinking than everything you do from an investment standpoint cannot have a higher expense ratio than X.
Right.
Which is what a number of people on the internet advocate for.
Mm-hmm.
And there are general consumers out there who think that way.
Yes.
I'm not going to pay more than this number to have my assets managed because I think it's too high.
Okay.
Yeah.
I mean,
and
some people love spending hours on couponing.
Yep, they do.
I mean, and others of us go, rather take the same amount of energy and focus on how can I be more productive?
Yep. I'll share a somewhat personal story about what really started the change in thinking for me about this whole thing. And it goes back to...
It's when you met me and we started working.
That's okay. Yes, exactly. It goes back to when I met you and you shared this unbelievably wise observation with me. And I just said, it came about actually in the days of MetLife being in the whole life world business. And the arguments that companies like Northwestern used to make about average return on assets, which are important, by the way. I don't want to pretend like they're not. But one of the things that used to be a critical review on MetLife back in the day was that they had what looked like an embarrassingly low return on assets when you compared them to a Northwestern, a Guardian, a Mass, a Penn Mutual. So those companies would constantly ridicule MetLife when they were competing against them for business on whole life, and point out that, well, they've got a really terrible rate of return on assets when you compare it to us. We do better, so that means we're going to be able to produce more investment profits to pay our dividend. And that sounded great, but if you looked at the dividends that MetLife was paying on its business, they weren't bad at all. And when you started to break down the numbers at MetLife, what you started to realize was they have a lower return on assets because they generate a gargantuan amount of money from a humongous pile of assets that they've accumulated.
Right.
They are the largest or one of the largest life insurance companies in the country.
Or they used to be.
Yes. They got broken up and the whole life business is gone now. But because they are so large.
They were multiples larger than number 2.
Yes. Because they're so large, because they manage so many assets, the absolute dollars they have to generate to keep the whole life business good just isn't as much.
Right.
As some of these smaller insurance companies do.
Right.
And
which, by the way, didn't make them better necessarily.
Nope.
It just made this particular argument not relevant.
Less true.
Right.
So when you look at it and you understand the paradigm as more return also involves more risk, and you are prudently managing assets, you would say to yourself, well, if I can reach the objective with a lower amount of risk, I'm not going to reach for a higher return because I don't need to subject myself to the additional complications of that risk.
Right. Here's a great analog that you and I have talked about before. If someone has $500,000, these are the people on the internet that talk about this kind of stuff. They have $500,000 and they're comparing themselves to someone who has $50 million.
Yeah.
And they'll say, well, that guy has $50 million and all he does is buy 3-month T-bills. Yeah. What a sucker. I'm invested all in the S&P 500 index, and look at the returns that's done over the, past whatever years. This guy's over here making 3% on average. I realize
2 to 3 times better than he does.
Right. And I realize T-bills are paying more than that now. I'm just talking about over time.
Yep.
But so they'll say, well, what a dummy. That guy's only making 3%. I'm like, well, he's got $50 million. Mm-hmm. So turns out his 3%, not insignificant.
In real dollars, you can go to the store and buy stuff with. It's way more than your 8% on your portfolio.
Or your 12% or whatever it is. It doesn't really matter. So again, it's not that returns don't matter, but context is everything when it
it's a nuanced discussion.
Yeah.
Because there is the
guy who has 50 million would not like it if he woke up, and his 50 was worth 30.
Right. And he just doesn't have to deal with that.
Right.
And I know that there are some people who think that's crazy, because imagine how much more money he could have if he invested in the S&P 500.
Yep.
But that person generally doesn't look at it that way.
Right.
And it doesn't care.
Well, at 3%, they're generating $1.5 million.
Right.
So,
right.
I mean,
yes, I'd have another $1 million, but I don't care.
Right.
Because I don't need it.
Right. And the risk.
So the risk of incurring all that just isn't worth it.
Right.
And that is, again, part of this thought process, to look at the net and decide, okay, that's all that matters.
Yes.
Because, T-bills are fairly simple situations where we're not going to get deep in the weeds about expenses.
No.
And there are other things that people with that kind of money might invest in that do have some expenses, and they don't care.
Right. I was just drawing a simple,
a
simple line there.
Yep. But for sure, I think I remember conversations between you and I years ago about individuals who obsessed about expenses, who are typically in lower income, lower assets.
Right.
And we used to theorize that it had a lot to do with how much more significant that money was to them.
Right.
Versus somebody who had millions of dollars.
Sure.
But I honestly think that it really comes down to one begets the other, in the sense that those who get to a point where they've got tens of millions of dollars generally get there because they think this way.
Yeah.
Not because they were obsessive until they got there.
No. It's not that we said we were abandoning hokey, but here I am getting hokey again.
Part 2.
I can't scientifically prove any of this or say that I understand it, but it has something to do with where you put your energy.
Yeah.
It has to do with focus.
Yeah.
And the people who tend to succeed, this is just observation. They tend to focus most of their energy on what they're really good at.
Yep. They do. And they understand that doing that, focusing on what they're good at, bringing in more money, is more significant than just trying to shore up all your expenses.
Right.
There's been a fascination in the world of personal finance that has long suggested the path to massive financial independence is to cut your expenses to wealthy.
Right.
And I don't know anybody who's ever successfully done that.
Right. I see stories, but I don't know anyone personally.
I mean, sure, there's people who are thrifty who accumulate $1 million.
Sure.
But a lot of them that I've met, I wouldn't want to live their life.
Right.
And it's certainly been the case that a lot more people have gotten further ahead by focusing on the things they're really good at and trying to be more productive versus trying to be super managed on the expenses.
Right.
That's not to suggest you should just spend crazily and ignore expenses all the time. And for sure, you mentioned earlier in this episode that when it comes to making a whole life insurance purchase, if we're looking at, let's say, 2 or 3 whole life policies that were put together for cash accumulation, we do want to have some sense of what policy is going to perform best for us.
Yes.
And expense does play somewhat of a role in that evaluation. But I can tell you now that if you were to give me 3 whole life policies and you actually knew the expenses of the contracts and you could line them up for me, that does not mean I'm confident the one that has the lowest expenses will be the best performer.
Right. No.
We don't know that for sure.
Right.
And again, because there is a more predetermined path that these products will follow by virtue of how they work, we can look at the projections and get a really good sense without looking at expenses at all to know what one is the best deal. We've had a number of conversations with people over the years about whole life policies, comparing a few at a time. Say, look, this is what this company offers, that company offers, and that company offers. And this one in particular stands out the best.
Right.
And on occasion, the topic of load fees will come up because they are a component of paid up additions. And I think a lot of people have been unsatisfied with my answer to tell them that, look, all of that is assumed in the ledger.
Right.
So we don't need to create a table of who charges what, because when we look at these values as they unfold, all of that has already been factored in.
Right.
It's not going to be an additional expense that modifies the real number from what you see here in front of you.
Right.
Nor do they
These
change.
are all net numbers we're looking at.
Right.
So.
Nor do these things have a tendency to change after issue.
Right.
So it's not like it's going to go up.
Right.
And it's just not something that we can use to make a strong inference about what one is going to perform best over time.
Yeah. And the reality, at least the way I see it, is if you don't like it, don't buy it. Don't do it. If you don't think it's a fair exchange of value for the premium, then you shouldn't do it.
No. And there are a number of different applications to this that go beyond just life insurance. We've seen people in the investment world who get really hung up on the expenses of various things.
Right.
For reasons that are totally unnecessary.
Yep.
There are certain investment options out there that people will ridicule for their expenses, even though those expenses have zero impact on the performance people ultimately achieve from them.
Right. The inference is if something's more expensive, then that means they're getting it. The person who's selling it to you is getting a better deal than you're getting as the person who's buying it.
Right.
And that can be the case. I'm not saying that's never the case, but I mean, somebody's out there selling rainbow vacuum cleaners still. But
and there are people buying them and loving them.
Yeah, exactly.
Kirby vacuums.
Oh yeah.
Warren Buffett loves them.
But That doesn't make it good or bad.
No.
It may be good or bad for you.
Yep. That is absolutely true.
All right.
Okay. That's all we have to say about that.
All right.
So with that, I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.